Something interesting just happened in the Indian markets. We just had our best week in the last 5 years. And not just the Nifty, mid caps and small caps moved even more. The Nifty mid cap 150 was up 2.5% in a week, and Nifty small cap 250 was up 3.9% in that same week. Now, big weekly move can just be noise, markets bounce all the time. But what's interesting here is that this rally wasn't broad. It wasn't everything going up together. Only specific stocks moved and they moved sharply. And when that happens, it's usually telling you something. So we went through every mid-cap and small-cap stock that led this rally, looked at what's actually going on inside each business and tried to figure out, is this just a bounce or is something bigger starting to build? And we bring to you 10 such stocks with 5 mid-caps and 5 small-caps that led this rally and what each one is actually telling us as investors. So stay tuned till the end. So let's start with mid-caps. Here we are with stock number 5 on our list, which is PB Fintech, the company behind Policy Bazaar and Paisa Bazaar. If you think about what PB Fintech actually does, it sits between you and the financial products like insurance and loans and makes that whole process digital and easier. In a country where insurance penetration is still very low and most people still buy policies through agents, that's actually a very large and growing opportunity. But here's what really changed recently and why the stock moved nearly 9.6% in a week. PB Fintech has been a high growth company for a while. What it wasn't doing was making meaningful profits. That's now changing. In Q3, revenue grew 33% year on year and profits jumped over 160% year on year. That's not a small move on the bottom line. When a platform business like this transitions from growth mode to actual profitability, the market starts valuing it very differently. It goes from being priced on potential to being priced on earnings, and that can be a powerful shift. Insurance continues to drive the core growth, while the credit distribution business is stabilizing and adding incremental upside. The company is also moving into reinsurance and global markets, which could widen the revenue base over time. The honest caveat here, though, is valuation. The stock is trading at around 129 times PE with a market cap of close to 75,000 crore. Those are elevated numbers. The market is pricing in that this profitability holds and keeps improving. If growth slows or margin expansion stalls, those expectations will get tested pretty quickly. Now let's move on to stock number 4, which is Nippon Life India AMC. This one is a fairly straightforward story once you understand the context. More and more Indians are investing in mutual funds, SIP numbers keep growing. Retail participation in markets keeps increasing. An asset management company or AMC essentially manages all that money and earns a fee on every rupee it manages. So as the overall pool of managed money grows, the business grows with it. Nippon's quarterly average AUM grew 23% year on year to about 8.1 lakh crore. Market share improved to 8.65%, making it one of the fastest growing AMCs among the top players. Profit after tax was up 37% year on year to about 404 crore and operating margins are holding above 65%. That's a very profitable, very scalable business. The stock moved nearly 11% in a week, reflecting all of this. Now, one thing that often gets missed here is the passive side of the business. In ETFs specifically, Nippon has crossed 20% market share. ETFs are lower cost products, but they scale very efficiently and are growing fast as more investors move toward passive investing. They also have one of the largest investor bases in the industry, which is over 2.2 crore investors, which gives them real distribution depth. Despite this, valuations remain elevated at around 47 times PE with a market cap near 67,000. The risk to watch here is fee pressure. If SEBI tightens expense ratios further or it flows slow meaningfully, margins could come under pressure. That's the one thing to keep an eye on. Now let's move on to stock number 3, which is Radico Khaitan, and this one is about a very interesting consumer shift happening in India. People are drinking less, but drinking better. The move from mass alcohol brands to premium ones is very real and it's been happening quietly across India's alcohol beverage market. Radico is one of the clearest beneficiaries of that shift. Revenue grew nearly 19% year on year to around 1,547 crore last quarter. But the more important number is EBITDA, which jumped 45% with margins expanding to 17%. Revenue growing 19% but operating profit growing 45% tells you the product mix is getting richer. Premium volumes grew over 25%, which means the growth is genuinely coming from higher value products, not just selling more bottles. Brands like Rampur are also starting to get global recognition, which adds pricing power over time, something that's hard to build in this industry. The stock moved nearly 12% in the last week, reflecting this momentum. But at around 82 times PE and a market cap of 43,500 crore, the valuation is already pricing in a lot of this premium story continuing. Any slowdown in premium demand or any margin pressure would make these numbers hard to justify. Now let's move on to stock number 2, which is Bank of Maharashtra. And this one surprised a lot of people. It's a PSU bank with a strong focus on retail, MSME and corporate lending. But it moved around 12% in a week. And when you look at the numbers, it's not hard to understand why. Advances grew close to 20% year on year, deposits are up around 15%. Total business has crossed 5.9 lakh crore. Net profit rose about 27% year on year to nearly 1800 crore. And all of this is happening while asset quality is improving, not deteriorating. That combination, growth plus cleaner books, is exactly what the market rewards in a bank. When a bank can grow its loan book fast without taking on bad loans, it signals the management knows what they are doing. The stock is trading at roughly 9 times PE with a market cap in the 60,000 crore range, and it's close to its 52-week high, which reflects this re-rating that's already happened. The risk here is sustainability. PSU banks have had good runs before that didn't last. If asset quality slips or credit growth slows in the next few quarters, this momentum can fade. So watch those two numbers closely. Now let's move on to the most interesting mid-cap mover of the week, BHEL, which was up 14%. BHEL makes heavy power equipment, boilers, turbines, generators, basically the kind of large machinery that goes into thermal power plants. It's been a company that's had a massive order book for years but struggled with actually converting those orders into revenue and profits efficiently. That's what seems to be changing now. FY26 turnover came in at around 32,350 crore rupees, up 18%. Fresh order inflows were 75,000 crore and the total order book is now sitting at nearly 2.5 lakh crore. That's multi-year revenue visibility that most companies would dream of. The key shift the market is reacting to is execution. When a company with this kind of order book starts actually delivering, operating leverage kicks in very quickly because a large part of the cost base is fixed. More revenue on the same cost structure means margins improve sharply. BHEL is also no longer purely a thermal play. Industrial segments like railways and defense are now adding incremental growth, which is important as the energy mix evolves. But the valuation reflects all of this optimism. The stock is trading at around 145 times PE. That is a very high multiple for a company that's still in turnaround mode. The market is essentially betting that BHEL converts this enormous order book into sustained revenue growth. If execution slips or timelines stretch, that bet gets challenged fast. So those were the 5 mid-cap stocks that drove the rally. Now let's move on to small caps, and honestly, this is where some of the more interesting moves happened. These are less tracked, less talked about, and the moves were even bigger, so let's get right into it. Let's start with small cap stock number 5, which is Elecon Engineering. It went up 14.2% in a week. Elecon makes industrial gears and material handling equipment. These are the critical components that go into power plants, steel mills, cement plants. Not the most exciting description, but here's why it matters for an investor. When India's industrial and infrastructure capex cycle picks up, when factories get built, when power plants get commissioned, companies like Elecon become the proxy. They are supplying the machinery that makes all of it run. Now, the recent numbers are a bit mixed. FY26 revenue was around 2,366 crore, up about 6% year on year. But profits actually fell about 18%, which was impacted by weaker margins and some execution delays. So, on a trailing basis, it's not a great picture. But the market is looking forward here, and there's a reason for that. The order book has expanded to around 1,292 crore, providing near-term revenue visibility. And the material handling segment, which is one of their stronger divisions, grew over 35% year on year, showing where the next leg of growth is coming from. The stock is at around 32 times PE with a market cap of about 11,500 crore, and it's still about 30% below its 52-week high. So there's a re-rating case if execution recovers. But that's exactly the monitorable, execution. If margins don't normalize and delays persist, the recovery could take longer than what's being priced in right now. Now let's move on to stock number 4, Zen Technologies, which was up nearly 15% in a week. This is a defense company, and not just any defense company. They operate in simulation and anti-drone systems, training systems for soldiers, basically technologies that are genuinely in demand as defense budgets rise and modern warfare evolves. The numbers here are striking too. The company has delivered over 100% year-on-year growth in both operating profit and net profit recently, with PAT crossing 280 crore. That's a company scaling very fast. And the reason for that speed is the nature of the products. Zen doesn't just manufacture, it owns the technology. IP-led defense products are very hard to replicate, which means pricing power and switching costs are both high. Add a growing export focus on top of that, and the growth story gets more interesting. The stock is trading at around 60 times P with a market cap of close to 15,500 crore, and it's still meaningfully below its 52-week high of around 2,268 rupees. That gives room for re-rating if execution continues. The risk here though is order flow timing. Defense orders can be lumpy, big contracts come in and then there is a gap before the next one. Any delay in order conversion can hit growth visibility quickly. That's the key thing to watch here. Now let's move on to the next stock on our list, which is stock number 3, Gujarat State Petronet, which was up nearly 15% in a week. Now this one is genuinely interesting because GSPL is a gas transmission utility. It operates a pipeline network of over 4,300 km moving natural gas across industrial clusters in Gujarat. These kinds of businesses don't usually move 15% in a week. So what happened? The business itself is fundamentally strong. EBITDA margins typically stay above 70%, which is rare even within utilities. Gas transmission volumes have been gradually improving, supported by higher industrial demand and better LNG availability. And as India's gas consumption grows over time, GSPL sits right in the middle of that flow. The valuation is also relatively reasonable for a utility, trading at around 15 times P with a market cap close to 16,000 crore. That's not expensive for a business with stable, predictable cash flows. Now, the sharp weekly move might be catching up on sentiment rather than any one specific catalyst, but the underlying business quality is real. The risks are volume growth and global gas prices. If LNG prices spike again or industrial gas demand slows, transmission volumes can flatten and earnings visibility takes a hit. Now let's move on to stock number 2 on our list, Shipping Corporation of India, up 18.6% in a week. This is a different kind of story. Shipping Corporation operates crude tankers, bulk carriers and offshore vessels. It's a cyclical geopolitics sensitive business where earnings move more with freight rates than with any steady internal improvement. Right now, global tanker and shipping rates have stayed firm. The reason is a combination of supply tightness, not enough ships, and rerouting trends driven by geopolitical tensions, which means ships are traveling longer distances and staying busy. That's showing up in realizations. The company currently owns 58 vessels, recently adding 2 new ones. Now, from a valuation standpoint, it trades at roughly 12 times PE with a market cap near 13,000 crore and is near its 52-week high. The risk here is very straightforward, which is freight rates. Shipping is cyclical by nature. When rates were strong a couple of years ago, everyone was excited. Then that cooled off and the sentiment reversed. If global shipping demand softens, this momentum can fade just as quickly as it appeared. That's the nature of the business itself. And now stock number 1, Triveni Turbine. It was up nearly 21% in a week. Triveni makes industrial steam turbines, equipment that goes into power plants, sugar mills, chemical plants and various process industries. But here's what makes this company stand out from most capital goods businesses. It has a strong global footprint. A large and growing part of its revenue comes from exports and aftermarket services, which are both higher margin and more predictable than pure project execution. Aftermarket is particularly interesting because once you've installed a turbine, the customer keeps coming back to you for maintenance, spares and upgrades for decades. The numbers reflect this quality. Revenue grew over 24% year-on-year recently, EBITDA grew nearly 26% and margins have held strong above 22%, which is genuinely good for a capital goods goods company. A 21% move in a week is significant. The stock trades at around 52 times P with a market cap near 18,000 crore. And the move could be signaling a broader change in sentiment toward the capital goods and export-oriented manufacturing space. The thing to watch here is order inflows. Execution is clearly strong right now, but if fresh orders slow down, especially from export markets, growth visibility for the next few years starts to look less clear. So let's just step back and look at what this rally is actually telling us. 10 stocks across mid-cap and small-cap, different sectors, different business models, but a few common threads. Businesses with improving execution are getting rewarded. BHEL, Elecon, Triveni. Companies where profitability is finally scaling are seeing sharp re-ratings like PB Fintech, Nippon AMC. And cyclicals that are benefiting from global conditions are having their moment, like Shipping Corporation GSPL. Now the big question is this a one-week bounce or is something more durable starting? That's genuinely hard to say. But what you can do is watch the fundamentals of these businesses over the next 2 or 3 quarters. The stocks have moved. The question is whether the earnings catch up and justify these moves or not. That's the thing we'll be tracking. And if you want us to revisit any of these in the next quarter, drop it in the comments. We read every single one of them. If this was useful, like the video and share it with someone who's trying to make sense of what just happened in the markets. Subscribe so you don't miss such deep dives, and see you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.